I want to talk to you about one of the worst pieces of tax advice high earners follow. It sounds smart, it feels responsible, and almost every CPA reinforces it. Just reduce your taxable income this year. But here's the catch. If you follow that advice blindly, you can quietly build a massive tax problem for your future self. And most people don't realize it until they're staring at a 7-figure retirement account that's about to generate a 6-figure taxable income, whether they need it or not. And if you don't fix this, you can do everything right, earn well, save aggressively, invest consistently, and still build a massive tax issue for your future self. In this video, I'll show you how to legally reduce your taxes today without falling for expensive gimmicks, how to avoid building a massive tax trap in retirement that forces you into a higher tax bracket later, and the exact step-by-step framework high earners can use to smooth their taxes over the next 30 to 40 years, not just this year. A few years ago, I worked with a couple who had done everything right. They both had high incomes, they were disciplined savers, they maxed out their 401ks every single year. For more than 2 decades, they followed the playbook everyone praises. Defer taxes, invest consistently, don't overspend, stay the course. And it worked. By the time they were ready to retire, they had built a portfolio north of $3 million. On paper, a success story. But here's what no one had walked them through. Every single dollar of that $3 million was sitting in pre-tax accounts. Traditional 401ks, traditional IRAs, deferred compensation, which meant every dollar they pulled out was taxed as ordinary income. Every withdrawal pushed them higher into a bracket. Their Social Security benefit became partially taxable. Required minimum distributions at 73 were going to force 6-figure income whether they needed it or not. Medicare premiums were climbing because their reported income looked higher on paper. They had saved well, but they had built a tax trap. Pre-tax accounts are not tax elimination. They're just tax deferral. You're just choosing when you want the bill and at a future tax rate that nobody knows. And here's the uncomfortable part. When you load everything into pre-tax accounts, you're betting that future tax rates will be lower than they are right now. And if you don't think about that early in your 30s and 40s, when your earnings great, you can lose complete control later. This is exactly why my work centers around high earners in their 30s and 40s. Because I've seen this movie before. I've watched disciplined, successful people build 7-figure portfolios and unintentionally build 6-figure tax exposure right alongside it. And I'd much rather help you design this correctly while you still have time, flexibility, and leverage, instead of trying to unwind it when options are limited and the IRS is setting the schedule. That's the difference between reducing taxes this year and controlling your tax rate for the rest of your life. Now let's zoom out for a second. If you're earning $300,000, $400,000, or $500,000 a year, you don't really have a tax problem. You have a leverage problem. Here's what I mean. At those income levels, you're likely sitting in the 32 or 35% federal marginal bracket, maybe even 37%, depending on bonuses and equity. Add state tax, 5%, 8%, maybe 10%, depending on where you live. And now that top slice of your income is getting hit at 40% or more, which is exactly why strategic deductions matter. Because when you make a $10,000 pre-tax contribution while you're in a 35% federal bracket and say a 5% state bracket, that $10,000 isn't saving you 10%. It could be saving you 40%. That's a $4,000 back in your pocket immediately. Now, here's where leverage shows up. If that $4,000 is invested and compounds at 7% for 20 years, that single tax decision can turn into roughly $15,000. Now, zoom out even further. A $10,000 tax deduction invested at 7% for 20 years grows to nearly $39,000. But, and this is important, reducing taxes today is only half the equation. Because if every dollar you save ends up in pre-tax accounts, you might be solving today's leverage problem while quietly building tomorrow's tax trap. So the real question becomes, How do you reduce taxes today intelligently? Let's start with the obvious layers, but let's understand why you're pulling them. Most high earners I meet are contributing to their 401k, but there's a difference between contributing and optimizing. If you're sitting in a 32%, 35%, or 37% federal bracket, and your 401k contribution is removing income from the most expensive slice of your pay, that's leverage. When you defer $23,000 while you're in a 35% federal bracket and a 5% state bracket, that decision can shield roughly $9,000 from current taxation. That's real money. Now, here's the guardrails. If 90% of your long-term wealth is already projected to land in pre-tax accounts, blindly maxing pre-tax every year without running projections may be increasing future exposure. Another option is the HSA. Most people treat their health savings account like a checking account for medical expenses. Use it, spend it, move on. That's a mistake. An HSA is triple tax advantage. You get a deduction going in, it grows tax deferred, and withdrawals for qualified medical expenses are tax free. That combination is rare. Here's the advanced move. If you can afford to, pay current medical expenses out of pocket. Let the HSA stay invested. Let it compound for 20 or 30 years, then reimburse yourself later. Healthcare is one of the largest expenses in retirement. Would you rather pay that from a fully taxable IRA or from a tax-free bucket you built intentionally? Now, at some point, someone may tell you the answer is permanent life insurance, and this is especially common with high earners. Let me be clear, insurance has a purpose, but if someone is leading with insurance before you fully optimize your 401k, HSA, Roth strategies, taxable investments, cash flow, you should pause. For most high-income W-2 earners, maximizing high-impact retirement accounts and building diversified investments creates more flexibility than locking up capital in high-fee policies. We're trying to build control, not complexity. Another thing we need to discuss are taxation on bonuses and equity. Most companies withhold 22% federal on bonuses up to $1 million, but your actual marginal rate might be 32%, 35%, or 37% plus state, which means one of two things happens. You underwithhold and write a painful check in April, or you overwithhold and give the IRS an interest-free loan all year. Neither is strategic. A simple mid-year tax projection can fix that. Adjust your W-4, coordinate vesting events with other income, plan before equity hits, not after. If you have a taxable brokerage account, especially one with company stock you're diversifying out of, tax loss harvesting becomes another lever. Losses offset gains. If losses exceed up to $3,000 offsets ordinary income. Unused losses carry forward indefinitely. This isn't market timing, it's tax asset management. All of these strategies reduce taxes today, and you should absolutely use them. But here's the pivot. If every dollar you save flows into pre-tax accounts, you might be winning the battle this year and losing the war over the next 30 years. Let's go back to that couple with $3 million in pre-tax accounts. Here's what was coming for them: required minimum distributions. Now, depending on your age, this might seem like something far off, but it needs to be planned for. Under current law, RMDs start at age 73, and the percentage you're required to withdraw increases every single year. On a $3 million traditional IRA, that first required distribution can easily exceed $110,000, fully taxable. That's before Social Security, before pensions, and before any other income. Had they diversified their tax buckets earlier, they could have controlled how much income showed up each year. Instead, the IRS was setting the schedule. Which brings us to the framework that changes everything. I want you to picture your money in 3 buckets. Bucket 1, tax deferred. This is your traditional 401k, traditional IRA, and deferred compensation. You get the deduction today, you pay ordinary income later. Bucket 2, tax-free. This is Roth accounts and strategically invested HSAs. Money where you've already paid the tax and future withdrawals are tax-free. Bucket 3, taxable brokerage. There's no upfront deduction, but long-term capital gains treatment and dividend flexibility. And no forced withdrawal schedule. Now, here's the question that matters. What percentage of your net worth is in each bucket? Because if 85 to 90% or more of your wealth is sitting in bucket 1, you don't have a strategy. You have concentration risk. But if you intentionally build all 3 buckets over time, something powerful happens. You gain control. You can control how much ordinary income you recognize each year. You can fill lower brackets on purpose. You can manage capital gains exposure. You can potentially avoid Medicare premium cliffs. Instead of the IRS telling you how much income you must take, you decide how much income shows up. That's what tax diversification really means. Not avoiding taxes, controlling the timing. And timing over 30 or 40 years is everything. If you're a high earner at a large company, chances are your compensation isn't just salaries. It's RSUs, ISOs, NSOs, ESPPs, and large bonuses. And here's the mistake I see over and over. People treat equity decisions like investment decisions, but they're tax timing decisions. An RSU vest is ordinary income the moment it hits. An ISO exercise can trigger AMT depending on timing and spread. Stacking a large option exercise in the same year as a big bonus and major vesting event, and you can spike yourself into a higher marginal bracket without even meaning to. Now, let's slow down. Imagine this year you have a $300,000 in base salary, a $100,000 bonus, and $200,000 in RSU vesting. That's a combined total of $600,000 of income before you even touch options. If you then decide to exercise $250,000 worth of ISOs in the same year because the stock looks good, you may have just created a massive tax acceleration event. Not because it was wrong, but because it wasn't coordinated. A single 6-figure equity event can shift your marginal tax rate dramatically. That's why projections matter, not in April, but in June, before the vest, before the exercise, before the year is locked in. This isn't about being aggressive, it's about being intentional. Because once income shows up on your W-2 or 1099, your flexibility shrinks. I now want to talk to you about a simple way to think about your lifetime tax framework. If you want to legally reduce your taxes and actually keep more of what you earn, here's the framework. Step 1, know your true marginal rate. Federal plus state. Include bonuses and equity income. Because if you don't know where your next dollar is taxed, you can't evaluate whether a strategy is smart or just noise. Step 2, maximize high impact tax advantage accounts. For most high earners, that means 401k contributions, especially when you're in a high marginal bracket. HSA contributions if you're eligible. Backdoor Roth contributions when appropriate. Mega backdoor Roth if your plan allows it. But here's the guardrails. Don't blindly shove everything into pre-tax accounts without projecting the lifetime picture. If 90% or more of your projected retirement assets are pre-tax, that's not efficient. That's concentration. Step 3, build tax diversification intentionally. Ask yourself, what percentage of my net worth is pre-tax? What percentage is Roth? What percentage is taxable brokerage? If the answer is almost all pre-tax, you need to start correcting that while you still have time. Time is leverage. The earlier you diversify tax buckets, the more control you gain later. Step 4, coordinate equity with projections. Before you exercise options, sell concentrated stock, accept a large bonus, you need to run projections. A single unplanned 6-figure equity event can cost tens of thousands in unnecessary taxes. Step 5, model your future RMDs now. Even if retirement is 10, 15, maybe 25 years away, project what your traditional accounts could grow to. Estimate what required withdrawals might look like. Identify potential Roth conversion windows early. Clarity now prevents forced decisions later. Look, you earn too much to leave this to guesswork. Reducing taxes this year is good, but controlling your tax rate for the next 30, 40, or 50 years, that's how you turn a great income into real lasting wealth. And here's something most high earners don't connect soon enough. Most young parents delay estate planning because we're healthy. We don't have a huge estate. We'll do it when the kids are older. So if you want to understand how to build a legacy plan while your kids are still young, in a way that gives you peace of mind now, not someday, that's what I break down in the next video right here. Click here and I'll walk you through it.